You're tuned in to Agriculture Today, and we start our Friday show with a grain market outlook from K-State grain economist Dan O'Brien. Dan, thanks for joining us today.
Thank you very much, Shelby.
Dan, what level are we seeing for futures prices right now?
Well, there is the overall perspective of the markets that's generally pretty pessimistic on prices, and I don't think anybody following ag markets right now is surprised by that. That's what we've been seeing for about the last month. Corn yesterday, July corn, closed at 439 and a half. The D's contract actually has showed some recovery up to 448 and a quarter, getting back to around the $5 area. And we had dropped to about 430 or so on that D's contract. So, in fact, it's kind of interesting to look what's happened in the futures complex in the last day or so. That the upfront contracts still pretty weak, but the later contracts actually moving up some. And I'm not sure exactly the combination of either production issues or geopolitical worries that's causing that to happen, but we have seen that occur. And as you talk about corn in particular, again that 439 and a half close here yesterday. When you compare historically where we've been in the short run, we've been as low in latter part of 2024 around harvest or so. We got down to about 385 here this spring, about to 518. So we're almost in the middle of that range. And if we had sharp weather concerns in the U.S. right now, we'd probably be closer to five at this point. But we've had moisture. People aren't really worried at this point about that. I would say for corn that low prices, a combination of low prices and relatively a little bit of a weaker U.S. dollar have have encouraged U.S. corn exports and aren't doing anything to discourage corn usage in ethanol. So we've had some pretty good usage. The corn export number for the week ending May 29th was basically 65 million bushels, and so in essence we're basically with 39 out of 52 weeks done in the marketing year, we're 75% of the way through. We're about 75.5% of the way to meeting the USDA's projection. So that's great news. A lot of times we trail those in the actual shipments market. And we've got bought ahead almost 99% of the USDA's projection, 2.6 million, billion bushels. Yeah, and that's again 99% of the way to meeting the USDA's goal of 2.6 billion, which is a strong export year. And again, we're only 75% of the way through the marketing year. So strong positive news in the corn market in terms of actual usage. And again, moisture coming has, pardon me a second. Moisture coming has kind of allayed any fears right now of crop issues. Though if those problems come, they're out in front of us and in the latter part of June, July, and August, but they're not here yet. So you kind of have what you have there. And then in the wheat market, we've had really weak prices, but strong exports of late also. So here we've had the close in the wheat market, pardon me, on July hard red winter wheats and contract on that contract yesterday at 542 and a half. And if that 542 and a half is above where we were about a month ago, we got down to as low as $5. We here within the last 4 or 5 months, we had been at about 642 for a high. So 542 is better than where we had been. The times when we have really seen lower wheat prices in the last 5, 10 years, we got down to about 395, 380 thereabouts. So that we've got a little bit better situation than that, but still, as a cash price in terms of the futures markets heading into harvest, then we're sitting at sort of a moderate to lower than hoped for price. Now I understand later on today Romulo Lulato will be coming on the radio program and talking about the actual production issues. So Romulo can talk about any I guess optimism or fears in terms of where the crop will finally come out at. I would say that with the lower prices, we've seen about the strongest wheat export week we've seen for a while. Just under, well, about 19 under just under 20 million bushels, about 19.8. And for a lot of weeks, Shelby, as you and I would be sitting here talking about this, we'd be looking at 8, 9, 10 million bushels. Well, suddenly, about the last 3 weeks in a row, we're really moving wheat. In the U.S. overall here for hard red, uh, about 5.4 million. We were at 7.5 uh, last week, I believe, or over 7. And again, a lot of weeks during this marketing year, we were struggling to get to 1 or 2 or 3 million bushels. Well, now we've got this great guns situation going on. And you can ask, well, what is that? Well, yeah, it's lower prices in the U.S. are helping to spur demand, so that's good, and the value of the dollar is at issue. But also, you got that this the reemergence of worries in the world market about world wheat market about the geopolitical conflict in Ukraine and Russia. And I would say when you look at the drought maps in that part of the world, it looks pretty dry for especially Russia, but also Ukraine has issues. So I haven't heard of grain shipments being disrupted yet, as we look for market news. But still, you've got those worries re-engaging, coming back into the market, and it may not be so much of an issue right during the depth of our harvest. We'll have pretty massive oversupply in the short term, but I would wonder how we come out of harvest when what's going to be sold is going to move, and what and going to move into the market, and what's hasn't been sold is kept back to see what type of a trend that we're or what type of market trend there might be, what reward to storage there might be coming in. So you got that happening in the wheat market, and then soybeans. Really, the soybean market has hung right around 10.25, 10.50 for a good long time for the futures. For the July contract closed at 10.51 and 3/4 yesterday. November contract 10.33 and a quarter, and really no carry showing up in that market. I should say there's still 6 to 7 cents per bushel per month carry in the wheat market for hard red winter wheat going on down the road. So whereas the hard red winter wheat market's definitely encouraging people to store at these prices, that for the soybean market, not so much, really almost no carry at all till you get way past the first of the year. So anyway, you got that, and soybean prices as they're standing right now at 10.51 and 3/4, or where they were on yesterday's close, that you're looking at an area that is above where we've tended to be when we've uh, when we've been on the lower end of prices over the last 10 years. When we've gotten tougher and into a tougher situation, it's been more like 776 for lows, 791, 844. But here in the last several years, we haven't seen anything below 950. But over the last decade, we've certainly been lower. Within the last several months, we got down to 955, and as a low, about 1079 as a high, and we're at about 1051 3/4 right now. The soybean market's held back by strong strong production in South America, and so that's and that's affected the pace of exports. We were running pretty strong for soybean exports until the Brazilian crop in particular started to come in, and now here we need about 16 million bushels per week to meet the USDA's projection for the marketing year, and here we've been running at about 11, 10, 11, 12, 15, something like that. So actually have fallen behind pace to meet the USDA's forecast 1.85 billion. So we'll see, and even those numbers projected forward from the soybean market are a source of some controversy for some people. So I guess wondering if as you go into the next marketing year, when we're shooting for soybeans at again 1.8 billion bushels plus, whether we're going to be able to attain that or not. But I guess I would counsel people that the USDA, when they put out these export numbers, they've tended to be pretty optimistic year after year after year. So I don't think there's any untoward approach that the USDA is using in making their projections for exports for the next market year. They tend to expect as a practice, normal production, low prices, and higher usage.
You've made a mention of geopolitical uncertainty and concerns a little bit in this interview. Can you explain to us a bit more about what you're seeing on that front?
At this time, we've got two centers of concern. What's one being the U.S.-China trade issues that are going on, and the other, of course, as we'd mentioned, the Ukraine-Russia war. And here of late, again, we're focusing on gray markets here, not so much on military conflicts, but some of the recent actions with that happened between Ukraine and Russia have shaken the status quo more, brought more worries about retaliation and all of that. And so far, not a lot of impact on grain shipments coming out of that part of the world, but we shall see. Uh, and and with regard to China, the we've talked about tariffs and they have their own internal political issues going on right now from what we read in the legitimate press with regard to that. So that's something to watch with regard to leadership over there. But in the midst of all that turmoil, tariffs on the one hand, political change possible on the other, a big drought has hit in Chinese wheat production areas. China hasn't been a big buyer of U.S. wheat here of late, and it's a lot of that. Some of that's political tariffs and whatever you want to talk about. But but if China finds themselves having to aggressively come onto the world market from anywhere to buy, then it starts to crowd out other people that would be going to, the other major wheat exporting countries of the world, Australia, Argentina, the EU, again, Black Sea, the Black Sea countries we've mentioned. If China goes into those countries and starts bidding top dollar because, hey, we're tight, and in terms of their domestic supplies, then it forces other buyers who can't compete with what China is going to do to come start buying from the U.S. So, that could be part of what's going on in the world wheat markets. Is that China's responding to what they have, going into the market, getting hold of supplies wherever they can, and other buyers having to compete with that sharp demand from China, and then coming to the U.S. As a second resort. We have been talking of late about how the U.S. has tended to be, especially when we had a higher dollar, the kind of supplier of last resort. And part of that's because, hey, we can store these crops and keep them in condition, and we can finance that. And other countries, when they produce something, they just send it. They don't either have the storage facilities or the financial acumen or even the transportation to do what we can do. So we've tended to hold granaries together. Well, now you've got a situation where, gosh, these other suppliers around the world, other users around the world are looking for supplies, and I guess here we've got it. So maybe this is the time we always think will eventually happen when gracious the other world. When the buyers of the world do need to come and find supplies wherever they can, and that would be us at a time like this.
Dan, I appreciate you taking the time to join us today.
Thank you very much, Shelby.
That was K-State grain economist Dan O'Brien. We're cutting to a short break now on Agriculture Today, but stick around because we have more for you up ahead.